This video discusses Form 2555 and the Foreign Earned Income Exclusion. First, we will briefly go over the requirements to claim the exclusion, and then we will review the form line by line. To simplify the video, we will not be going over the housing deduction, which is generally applicable to self-employed individuals. If you are a U.S. citizen or a U.S. resident alien living in a foreign country, you are subject to the same U.S. income tax laws that apply to citizens and residents living in the United States. However, if you meet certain requirements, you may be able to exclude up to $102,100 of foreign earned income for 2017. You qualify for the foreign earned income exclusion if you have foreign earned income, you meet the tax home test, and you meet either the bona fide residence test or the physical presence test. Foreign earned income generally means income you earn from services you performed in a foreign country. Where the employer is located and where the payment is made are not relevant to determine if the income is foreign income. The term foreign country does not include U.S. possessions, U.S. territories, Antarctica, or international waters. You must actually be in a foreign country or in the country's territorial waters or airspace. Earned income does not include income from pensions or annuities, income as an employee of the United States government, or certain deferred payments, such as income that is received after the year after the services were performed. For example, if services are performed in 2016 and payment is received in 2018, the payment received in 2018 cannot qualify for the exclusion. These deferred payments sometimes occur with the payments of bonuses. So we just discussed the first requirement, having foreign earned income. The second requirement is the tax home test. To meet the tax home test, your tax home must be in a foreign country or countries throughout your period of bona fide residence or physical presence. Your tax home is your regular or principal place of business, employment, or post of duty, regardless of where you maintain your family residence. If you don't have a regular or principal place of business because of the nature of your trade or business, your tax home is your regular place of abode, the place where you regularly live. There is a special rule, however, that says you aren't considered to have a tax home in a foreign country for any period during which your abode is in the U.S. The classic example of having an abode in the U.S. is an offshore oil rig worker who works a 28-day on, 28-day off schedule, returning to his or her family residence in the U.S. during the off periods. This oil rig worker would be considered to have an abode in the U.S. and would not meet the tax home test. So having a foreign tax home was the second requirement. The third requirement is to meet the bona fide residence test or the physical presence test. To meet the bona fide residence test, you must first either be a U.S. citizen or a U.S. resident alien who is a citizen or national of a country with which the U.S. has an income tax treaty in effect. Second, you must be a bona fide resident of a foreign country or countries for an uninterrupted period that includes an entire tax year, typically a full calendar year. Whether you are a bona fide resident of a foreign country depends on your intention about the length and nature of your stay. Various factors are considered to determine if you are a bona fide resident of a foreign country. To meet the physical presence test, you must be a U.S. citizen or resident alien who is physically present in a foreign country or countries for at least 330 full days during any consecutive 12 months. A full day means the 24-hour period that starts at midnight. Okay, we are going to shift gears and go through the Form 2555. At the top of the form, you put your name and social security number. If both you and your spouse qualify for the exclusion, you would each complete your own Form 2555. Part 1 provides general information. On line 1, you enter your foreign address. The IRS wants to know your foreign address because it may help them decide if they believe that you meet the requirements to claim the exclusion. For example, if your foreign address is an oil rig platform off the coast of a foreign country, you may have an abode in the U.S. and you may not have a foreign tax home. On line 2, you put your occupation. On line 3, you put your employer's name, and line 4 lists your employer's address. On line 5, you check the box as to what type of entity your employer is. Other could include things such as the U.S. government, a foreign government, NATO, the United Nations, the World Trade Organization, etc. The IRS may want to know the type of employer to determine if U.S. Social Security and Medicare taxes should be paid. Generally, an employee of a foreign employer would not be subject to U.S. Social Security and Medicare taxes, but an employee of a U.S. employer would be subject to such taxes. Also, if you list your employer as the U.S. government, That may suggest that you don't qualify for the exclusion. In this example, the taxpayer was employed by a foreign entity. Line 6 asks you to indicate the last time you filed Form 2555. Once you elect to claim the exclusion, that election remains in effect for that year and all future years unless it is revoked. In this example, we are assuming that the taxpayer filed the form in 2016. Check the box on line 6B if you didn't previously file Form 2555. Line 6C asks if you ever revoked the election, and if you did, line 6D wants to know what year you made the revocation. If you revoke the election, you cannot make the election again for the next 5 years unless you get IRS permission. Line 7 asks what country you are a citizen or national of. This could be important if you are not a U.S. citizen, but you are from a country that has an income tax treaty with the U.S., and you want to claim you meet the bona fide residence test. Line 8A asks about maintaining a second foreign household for your family. If you maintained a separate foreign household for your spouse and dependents at a place other than your tax home because the living conditions at your tax home were dangerous, unhealthful, or otherwise adverse, you can include the expenses of the second household as part of your housing expenses on line 28. Line 9 asks for your tax home and the date the tax home was established. Usually you would just have one tax home during the year. If your tax home changed during the year, you would list the multiple tax homes and dates established. Here the taxpayer moved to the UK in 2015 and established his tax home there in 2015. Part 2 provides information related to the bona fide residence test. On line 10, you enter the date your bona fide residence began and the date it ended. If you are still a bona fide resident, enter continues in the date ended space. Line 11 asks about your foreign living quarters. If you purchased a house, you rented a house or apartment, you rented a room, or your living quarters were furnished by your employer. If your housing was provided by your employer, such as on a secure compound, it may suggest that you are not a bona fide resident of the foreign country. Line 12A wants to know if your family lived abroad with you. If you are living abroad but your spouse and children remain in the U.S., it might put into question as to whether you are a genuine bona fide resident of the foreign country. On line 12B, you list the family members that lived with you. On line 13A, you indicate whether you have submitted a statement of non-residence to the authorities of the foreign country where you earned the income. Line 16B asks if you are required to pay income tax in that foreign country. If the authorities in the foreign country hold that you are not subject to their income tax laws by reason of non-residency, you aren't considered a bona fide resident of that country. In other words, if you answered yes to 13A and no to 13B, you probably can't claim that you are a bona fide resident of that foreign country. Line 14 asks you to indicate the days you were present in the U.S. during the year and any income you earned in the U.S. on business. If you spend a lot of time in the U.S. during the year, it may put into question whether you are a bona fide resident of the foreign country. In addition, any income earned in the U.S. would be considered U.S. source income and would not qualify for the exclusion. Here the taxpayer came to the U.S. on vacation for a week. Line 15 asks a number of questions, probing to see if it looks like you are really a bona fide resident of the foreign country. Line 15A asks for contractual terms regarding the length of your employment abroad. If your contract to work overseas is for less than a year, you may not be a bona fide resident of the foreign country. Lines 15B and C ask about your visa in the foreign country. If you are there on a tourist visa, which does not allow you to work there, your bona fide residence in that country may look suspect. Lines 15D and E ask about maintaining a home in the U.S. and information about that U.S. home. If you do keep a home in the U.S., it may or may not cast doubt upon whether you are a genuine bona fide resident of the foreign country. Part 3 deals with taxpayers claiming the physical presence test instead of the bona fide residence test. On line 16, you insert dates for the 12-month period on which the physical presence test is based. If you spent the entire year in a foreign country, you would put January 1 to December 31 of that year. However, if this was your first year claiming the exclusion, the start date of the 12-month period would be after January 1, and if this is your last year in claiming the exclusion, the end date would be before December 31. It is possible to even have two 12-month periods with the first 12-month period starting before the beginning of the year and ending during the year, and the second 12-month period starting later that year and finishing after the end of the year. This could occur, for example, if you are on an overseas assignment lasting for more than 12 months, you came back to the U.S. for several months during the year, and then you were sent on another overseas assignment lasting more than 12 months. On line 17, you list your principal country of employment during the year. This is almost always where your tax home is located. Line 18 asks for information about traveling to the U.S. or traveling on or over international waters or the U.S. If you had no travel to the U.S. and no travel on or over international waters or the U.S., put physically present in a foreign country or countries for the entire 12-month period. If you traveled to the U.S. and earned income in the U.S., you would list that income in column F for line 18, attaching a computation, and you cannot exclude this income as it is U.S. source income. Part 4 computes your foreign earned income. Foreign earned income means wages, salaries, professional fees, and other compensation received for personal services you performed in a foreign country during the period for which you meet the tax home test and either the bona fide residence test or the physical presence test. It also includes non-cash income such as use of a home or car and allowances or reimbursements. On line 19, you include your total wages, salaries, etc. On line 20, you include your self-employment earned income and partnership earned income. On line 21, you include your non-cash income, such as the fair market value of lodging, meals, or cars provided by your employer. On line 22, you include amounts you received as allowances or reimbursements. On line 23, you include any other foreign earned income. Line 25 includes as a deduction the value of meals and lodging provided by your employer that is excludable from your income because they were provided for your employer's convenience. The value of these meals and lodging would have been included on line 21. Line 25 backs out these items because they are excluded from income under Section 119. This taxpayer had wages of $150,000 and no other foreign earned income. Line 27 just carries forward the number from line 26 and asks if you are claiming the housing exclusion or deduction. If yes, you complete Part 6. If no, you go on to Part 7. In our example, the taxpayer is not self-employed. Thus, the taxpayer will not be claiming the housing deduction in Part 9, but he may qualify to claim the housing exclusion in Part 6. On line 28, you show the housing expenses for the year. The primary housing expenses typically include rent, utilities, and insurance. Mortgage payments do not qualify. This taxpayer had $50,000 of housing expenses. On line 29A, you list the location of where the housing expenses were incurred, but only if the location is one of the high-cost locations listed in the instruction. Otherwise, leave it blank. Line 29B is the limit on housing expenses. If you are not living in one of the high-cost locations, this amount is $30,630, which is 30% of the maximum annual exclusion of $102,100. If you are in a high-cost location, you include the amount from the table in the instructions. Here, London is a high-cost location, and the limit on housing expenses is $68,700. On line 30, you take the smaller of the actual housing expenses or the limit. Line 31 lists the number of qualifying days. This is usually 365, but may be less if you didn't qualify for the exclusion for the entire year, such as your first or last year qualifying. If you qualify for the exclusion for the entire year, the amount on line 32 will be $16,336, which is $102,100 times 16%. This is the threshold that the housing expenses must exceed. If the housing expenses do not exceed the threshold, no housing exclusion will be available. Line 33 computes how much your housing expenses exceed the threshold and says to stop if your housing expenses do not exceed the threshold. Line 34 asks you to input the employer-provided amounts. This will be all of your foreign earned income from line 27 if you were not at all self-employed. If all of your foreign earned income was provided by your employer, the amount on line 35 should be 1.000. Here the taxpayer is not self-employed, so his housing exclusion on line 36 is the amount by which the housing expenses exceed the threshold. Part 7 calculates the amount of the foreign earned income exclusion. Line 37 already includes the maximum amount that can be excluded. The amount is adjusted for inflation each year. On line 38, you include the number of days during your qualifying period in 2017, the same number as on line 31. On line 39, you compute a fraction, with the number on line 38 as the numerator and the total days during the year as the denominator. If you qualified for the entire year, you show 1.000 on line 39. On line 40, you multiply the maximum amount of the exclusion from line 37 with the fraction computed on line 39 to arrive at the maximum amount that can be excluded during the year. On line 41, you subtract the housing exclusion on line 36 from your total foreign earned income on line 27. Here the difference is $116,336. Then on line 42, you take the lesser of line 40 or 41. This is the amount of your foreign earned income exclusion. On line 43, you subtotal your housing exclusion and your foreign earned income exclusion. Here the total is $135,734. If you claim these exclusions, you cannot claim any deductions or credits related to the excluded income. Typically, deductions would be allocated to the excluded income for self-employed individuals. Here there were no deductions to be allocated against the excluded income, and line 44 is 0. If all or a portion of your foreign income taxes paid relate to excluded income, you have to reduce your foreign tax credits on Form 1116. See line 12 of Form 1116. On line 45, you subtract the disallowed deductions from the excluded income. This amount is shown as a deduction on line 21, Other Income of Form 1040. If you claim the exclusion, you must first figure the tax on your total income as if the exclusion did not apply. Then you compute the tax only on the amount excluded. The difference is the amount of tax due for the year. The computer software typically does this calculation. This stacking rule causes non-excluded income to be taxed at higher marginal tax rates. Attach Form 2555 to your Form 1040 when it is filed. Mail your Form 1040 to one of the special addresses designated for filing Form 2555. These are Austin, Texas, or Charlotte, North Carolina, depending on whether a check is included. The first year you plan to take the foreign earned income exclusion, you may not yet have met either the physical presence test or the bona fide residence test by the due date of your tax return. In this case, you can apply for a special extension of time to file on Form 2350. As an alternative to using this special extension, you can timely file your Form 1040, not claim the exclusion, and then amend your Form 1040 after you qualify and attach the Form 2555. If you are in a high tax country, you should consider not electing the exclusion. Claiming foreign tax credits may eliminate U.S. tax due for the current year and may allow excess foreign tax credits to be carried forward to a future year. The foreign tax credit carryforwards may provide a benefit in a future year.